56% of Americans cannot cover a $1,000 emergency. That means more than half the country is one car repair, one medical bill, one broken appliance away from financial disaster. Your emergency fund is not just a savings account. It is the difference between a bad week and a ruined year. Between stress and peace. Between surviving and actually living. Today we are walking through every level of emergency fund from $0 to $50,000. And I am going to show you exactly how your life changes at each stage. The transformation is not linear. It is exponential. Let us begin at the bottom. Where most people are right now. Level 1. $0. One disaster away from collapse. At $0 in savings, you are living on a razor's edge. Every single unexpected expense becomes a crisis. A flat tire is not an inconvenience. It is a catastrophe that cascades through your entire financial life. This is where payday loans enter the picture. The average payday loan carries an annual percentage rate of 391%. You borrow $400 and owe back $470 in 2 weeks. Miss that payment and it doubles. 80% of payday loans are rolled over or followed by another loan within 14 days. The average borrower spends 5 months per year in debt to payday lenders. It is not a bridge loan. It is a trap designed to keep you paying forever. Credit cards become the next trap. You put the emergency on plastic at 24% interest. Minimum payments barely cover the interest. A $1,000 emergency becomes $1,500 over 2 years of minimum payments. But the financial damage is not even the worst part. The stress tax on your health is devastating. People with zero savings have cortisol levels 27% higher than those with even modest buffers. That chronic stress causes heart disease, weakened immunity, and cognitive decline. You lose sleep. You snap at your partner. You cannot focus at work, which threatens the very income keeping you afloat. Zero savings is not just a financial state. It is a health crisis, a relationship strain, and a cognitive prison all at once. The cruelest part is that being broke is expensive. You pay overdraft fees. Late payment penalties. Higher insurance rates because of poor credit. You buy cheap items that break and need replacing. Poverty has a surcharge. The poverty premium costs the average low-income American between $500 and $1,000 per year in extra fees, higher prices, and forced suboptimal purchases. Being broke literally costs money you do not have. And the mental bandwidth tax means you cannot even plan your way out effectively. Your brain is so consumed with immediate survival that strategic thinking becomes neurologically impossible. It is not a character flaw. It is a brain state. Level 2. $500. The first real threshold. The Consumer Financial Protection Bureau identifies $500 as the minimum threshold for financial stability. It sounds tiny. But this single buffer changes your relationship with emergencies fundamentally. At $500, you can cover a minor car repair without borrowing. A new tire. A battery replacement. An oil change that was overdue. These small fixes no longer spiral into debt emergencies. You can replace a cracked phone screen. You can cover a small medical copay. You can handle a minor plumbing issue. These are not luxuries. These are the basic repairs that keep your life functioning without debt. Studies show that having just $500 in accessible savings reduces the probability of being evicted by 40% and reduces the likelihood of missing a utility payment by 65%. $500 is a firewall against cascading failure. Psychologically, this is where hope begins. You have proven to yourself that saving is possible. That buffer, however small, is evidence that you can build something. And that belief changes your behavior going forward. $500 also breaks the payday loan cycle. When a $300 emergency hits, you pay it from savings instead of borrowing at 391% interest. That single avoided loan saves you over $1,000 in fees over a year. The hardest part is getting from 0 to 500. After that, momentum takes over. Your brain has tasted security and it wants more. Protect this feeling. It is the foundation everything else is built on. Level 3. $2,000. The first real buffer. $2,000 covers most car repairs. A transmission issue. Brake replacement. An alternator failure. These are the repairs that strand people without savings and force them into predatory lending. It covers an emergency room visit copay. In the United States, the average copay ranges from $150 to $3,000 depending on your insurance. At $2,000 saved, you can seek medical care without the financial fear stopping you. This is the level where you stop avoiding the doctor. You stop driving on bald tires. You stop ignoring that weird noise in your engine. You can actually maintain your life instead of just reacting to crises. Appliance replacement becomes possible. When your refrigerator dies, you can replace it within days instead of eating takeout for a month while you scrape together money. When your washing machine breaks, you are not hauling laundry to a laundromat for weeks. At $2,000, research shows financial anxiety drops by 52% compared to zero savings. Your sleep improves. Your relationships improve. Your work performance improves. All from $2,000 sitting in an account you hopefully never touch. $2,000 is also the psychological threshold where you start feeling like a saver rather than someone who is broke. Identity shifts matter. When you see yourself as someone who has money set aside, you protect that identity with better financial decisions. You can also start saying yes to small opportunities. A friend invites you on a weekend trip. A professional conference has early bird tickets. A course goes on sale. $2,000 in savings means these are not impossible luxuries. They are reasonable choices. The Federal Reserve reports that households with $2,000 or more in savings are 74% less likely to use payday loans and 61% less likely to carry revolving credit card debt. This single buffer breaks multiple debt cycles simultaneously. Level 4. $5,000. 1 month of breathing room. $5,000 represents approximately 1 month of expenses for the average American household. This means if you lost your job tomorrow, you would not immediately default on rent. You have 4 weeks to find new income. 4 weeks does not sound like much. But it is the difference between taking the first desperate job offer and having time to find something decent. It is the difference between panic and strategy. At $5,000, all standard insurance deductibles are covered. Your health insurance deductible. Your car insurance deductible. Your home or renter's insurance deductible. Insurance actually works for you now because you can afford to use it. The average health insurance deductible in 2026 is $1,600. The average auto deductible is $1,000. Home insurance averages $2,000. At $5,000 saved, you can absorb any single deductible without financial strain. You start making better long-term decisions at this level. You can buy annual subscriptions instead of monthly ones, saving 20 to 30%. You can buy in bulk. You can wait for sales instead of buying out of urgency. Your negotiating power increases. You can negotiate bills, ask for discounts, and push back on price increases because you are not desperate. Desperation is expensive. Security is a discount card for life. $5,000 also means you can take a small calculated risk. Invest in a certification that costs $2,000. Start a side hustle that needs initial inventory. Say yes to an opportunity that requires upfront capital. At $5,000 saved, you have surpassed 63% of American households in emergency preparedness. You are already in the top third. And the psychological benefits compound from here exponentially. Level 5. $15,000. 3 months. This is where everything changes. 3 months of expenses is the standard financial advisor recommendation for a reason. It gives you enough runway to survive a job loss, find new employment, and maintain your life without touching credit cards or retirement accounts. But the real power of $15,000 is not surviving job loss. It is the ability to quit. You can leave a toxic job. You can walk away from a boss who disrespects you. You can say no to overtime that is destroying your health. The psychological research on toxic workplaces shows that staying in a harmful job for more than 18 months causes measurable damage to self-esteem, relationships, and physical health. $15,000 is not just savings. It is an escape hatch from environments that are slowly destroying you. Most people stay in jobs they hate because they cannot afford even 1 month without a paycheck. $15,000 buys you the most valuable thing in the modern economy. The power to walk away. You can take time between careers. Instead of jumping from one job to the next out of desperation, you can take 2 weeks to decompress, reflect, and search intentionally. That breathing room often leads to significantly better next positions. Data shows that people who take at least 2 weeks between jobs earn on average 12% more in their next role compared to those who jump immediately. The buffer pays for itself through better negotiation and less desperate decision-making. You negotiate from strength at this level. Salary negotiations. Freelance rates. Contract terms. When the other party senses you do not need them, the dynamic shifts entirely in your favor. Desperation leaks through every interaction. Security radiates confidence. $15,000 also opens the door to calculated risks. A certification course. A career pivot. A move to a city with better opportunities. You can invest in your future because your present is secure. Your health improves measurably at this level. You can afford preventive care. You schedule the dentist appointment you have been avoiding. You get the physical. You address that nagging pain. Prevention is cheaper than emergency treatment, but only if you have the buffer to pay for it. People with 3 months of savings visit the emergency room 47% less often than those with no savings. Not because they are healthier genetically, but because they can afford preventive care that catches problems early. Level 6. $30,000. 6 months. True financial security. 6 months of expenses is where financial advisors say you cross from surviving to thriving. At this level, you can weather almost any personal financial storm without long-term damage. Job loss. Medical emergency. Family crisis. You are covered. You can take real risks at this level. Start a side business without the pressure of it needing to replace your income immediately. Give it 6 months to find product market fit while your savings cover the gap. You can move cities. Relocate for a better opportunity, lower cost of living, or simply a place that makes you happier. The logistics of moving cost $3,000 to $8,000 on average. At $30,000 saved, that is manageable without stress. Your relationship with work transforms completely. You work because you choose to, not because you have to. That psychological shift changes how you show up. You are more creative, more assertive, more willing to propose bold ideas because failure does not mean homelessness. Research from the Federal Reserve shows that households with 6 months of savings report 68% higher life satisfaction than those with less than 1 month. They also report 43% better physical health outcomes. Security is literally medicine. At $30,000, you stop thinking about money daily. It fades into the background of your life where it belongs. You think about your work, your relationships, your health, your growth. Money becomes infrastructure, not obsession. You become generous naturally. You can pick up the check without calculating. You can help a friend in need without endangering yourself. You can donate to causes you believe in. Generosity from security feels completely different than generosity from guilt. At $30,000, you have options that 90% of people will never experience. Not because you are smarter or luckier, but because you made the boring, consistent choice to save when spending was easier. That discipline is now paying dividends in freedom. Your confidence in conversations changes. In negotiations, in relationships, in every interaction. People can sense when someone has a safety net. It shows in your posture, your tone, your willingness to hold boundaries. Financial security is visible even when you never mention money. Level 7. $50,000. Beyond emergency. Into opportunity. At $50,000, you have transcended the emergency fund entirely. This is no longer about surviving bad things. This is about being positioned to seize good things when they appear. An investment opportunity appears. A friend's startup needs early funding. A property comes on the market below value. A business idea finally has a clear path. At $50,000, you can say yes without destroying your safety net. You can invest in yourself at this level in ways that were previously impossible. A full career change with retraining. A sabbatical to write the book. 6 months to build the app. $50,000 buys you time to become someone new. You can weather any storm at this level. A recession. A pandemic. An industry collapse. A health crisis that takes you out of work for months. $50,000 means no single event can financially ruin you. During the 2020 pandemic, people with 6 months or more of savings reported 53% less anxiety than those living paycheck to paycheck. Same global crisis. Same uncertainty. Completely different psychological experience based solely on that savings buffer. You also become someone others can rely on. When a family member faces a crisis, you can help without destroying your own stability. That ability to support people you love without self-sacrifice is one of the most underrated benefits of financial preparation. At $50,000 in liquid savings, you are in the top 15% of American households for emergency preparedness. You have more financial resilience than 85% of the country. That is not wealth. That is simply preparation that most people never achieve. Your stress levels at this point are comparable to people earning twice your income but living paycheck to paycheck. The savings buffer provides more psychological benefit than the income itself. How much you keep matters more than how much you make. You start thinking generationally. Can I help my children avoid the struggle I went through? Can I fund their education? Can I give them a head start? $50,000 is where your financial decisions begin affecting people beyond yourself. At this level, your emergency fund should be split strategically. $10,000 in a checking account for immediate access. $20,000 in a high-yield savings account earning 4 to 5%. $20,000 in short-term treasury bonds for slightly higher returns with minimal risk. This allocation strategy means your emergency fund is actually earning you $1,500 to $2,000 per year in interest while remaining fully accessible. Your safety net is paying you to exist. Money working for money. Beyond $50,000, you transition from emergency fund to investment portfolio. The next dollars should go into index funds, real estate, or business ventures. The emergency fund is complete. Now you build wealth on top of the foundation. The final truth. The goal was never the number. It was never about having exactly $50,000 in a savings account. The goal is the feeling. The feeling of safety. Of options. Of breathing room. Of knowing that life cannot knock you down with a single punch. Some people need $10,000 to feel that. Some need $50,000. It depends on your expenses, your risk tolerance, your family situation, and your personal history with money. There is no universal right answer. But I can tell you this with certainty. The journey from zero to your first $1,000 will change your brain chemistry more than any other financial milestone you will ever hit. That first buffer rewires your nervous system from survival mode to growth mode. Start where you are. $50 a month becomes $600 a year. $100 a month becomes $1,200. $200 a month gets you to $2,400 in 1 year. Small consistent deposits build the foundation that changes everything. Automate it. Set up an automatic transfer the day after payday. Make it invisible. Make it non-negotiable. Treat it like a bill you owe to your future self. Because that is exactly what it is. Do not touch it for lifestyle upgrades. Do not touch it for vacations. Do not touch it for anything that is not a genuine emergency. This money is not for spending. It is for sleeping well at night. Define what counts as an emergency before you need to decide under pressure. Job loss, medical crisis, essential repairs. Not a sale, not a vacation, not an investment. Write the rules when calm so you follow them when tempted. Keep it in a separate bank from your daily spending. Out of sight, out of mind. The friction of transferring between banks prevents impulsive withdrawals. Make it easy to deposit and hard to spend. Every level you climb on this ladder, your life gets measurably better. Not just financially. Emotionally. Physically. Relationally. An emergency fund is not a financial tool. It is a life tool. You are not saving money. You are buying peace. You are buying options. You are buying the version of yourself that makes decisions from clarity instead of panic. And that version of you builds a completely different life. Start today. Not tomorrow. Not next month. Today. Open the account. Set the transfer. Begin the climb. Your future self is waiting at the top of this ladder. And they are grateful you started now.